Hey, soldiers, one of the biggest and arguably one of the most famous private equity firms out there, Blackstone, not to be confused with BlackRock, Blackstone has actually defaulted on a major commercial real estate loan and has actually blocked investors from getting to their money. This is big news, guys, on several fronts. So it looks like these well-heeled, well-capitalized private equity firms are out there having some difficulties. And look, commercial real estate has been hit hard, all right, all over the world, thanks to politicians shutting down the economy and scaring the crap out of people for years now. The work from home, that whole trend has made a lot of businesses rethink their commercial space, all right? All right, so let's get into this because this is big news. And if you own a REIT, you know, it may have some legs for you. As I always say, you got to do your own due diligence. All right. REITs are a couple of steps removed from actually owning commercial property, but they do lower your risk. Now, we do see risk here because the people that are invested with Blackstone are having trouble getting access to their money. Let's find out what's going on. Before we do that, go ahead, hit subscribe, please. Become a soldier of finance. All it takes is, boom, hitting subscribe. Thumbs up this video as well. If you don't like this video, hit thumbs down twice. Let us really know about it. Now that soaring rates have burst the commercial real estate bubble, the carnage is coming fast and furious. So, okay, we got rising interest rates all over the world, and this is having an effect on these private equity firms who are invested in commercial real estate. This morning, Bloomberg has reported that Wall Street's largest commercial real estate landlord, private equity giant Blackstone, has defaulted on a 531 million euro bond backed by a portfolio of offices and stores owned by Sponda Oy. Sponda is a Finnish, they're from Finland, landlord that Blackstone acquired in 2018. Now, 531 million euros is equivalent to $562 million. While the private equity firm had sought an extension from holders of the securitized notes to allow time to dispose of assets and repay the debt, the surge in market volatility triggered by the war in Ukraine and rise in interest rates interrupted the sales process, and bondholders voted against a further extension. Now, so they were trying to liquidate to raise money, but it turns out that in a higher interest rate environment, people are, you know, the companies that could afford to buy these assets are a little reticent to do so at these interest rates. So that put the brakes on Blackstone being able to liquidate fast enough to make this loan payment. This is a situation that I think more firms are going to find themselves in as relates to commercial real estate, and maybe even real estate in general, to the extent that it is packaged in these bundles, in these investment or loan bundles that kind of are sold, kind of like the credit default swap, that whole thing. Now, we're dealing with a different situation in 2008 because we're not seeing the subprime stuff packaged in the same way. That high risk subprime stuff, bundles of loans packaged in the same way that we saw in the run up to the Great Recession in 2008. So that's on the residential side. Now, since the security has now matured, and they're talking about the security being that bond, that $562 million bond, since it has now matured and has not been repaid, the loan servicers, a company called Mount Street, they've determined that an event of default has occurred. Now, for you and I, they call this foreclosure, okay? But, you know, we're talking uptown here, high dollar. So we got to put some different nomenclature on it, and we'll call it an event of default. All right, so this event of default has occurred. The loan will now be transferred to a special servicer, all right? This debt relates to a small portion of the Sponda portfolio. This is according to a Blackstone representative trying to talk it down and make it appear that this is not what, this is not what it seems like. This is far, far less severe than it's being characterized. Look, you've defaulted on a major loan. That's the essence of this. The spokesperson for Blackstone goes on to say, "We are disappointed that the servicer has not advanced our proposal, which reflects our best efforts and we believe would deliver the best outcome for note holders." Now, you can't, if you or I were facing foreclosure, okay, we can't make a statement like this and say, "We are disappointed that the bank has not advanced our proposal to stretch this loan out and put the arrears on the end," because that reflects our best efforts. And we believe that that would deliver the best outcome. We can't say that. And look, the reason why we can't say that is because we do not have a loan worth $562 million. Blackstone is saying this because they know that most financial institutions don't want to look at defaulting on that much money. That is in the realm where it's not only going to hurt me, it's going to hurt you. Both parties are going to be impacted by that. Blackstone is understandably trying to minimize the news. The private equity firm clearly continues to scramble to stabilize the bleeding in its massive real estate portfolio. And on Wednesday, it said that it blocked investors from cashing out their investments at its $71 billion real estate income trust. It goes by the ticker symbol BREIT, as the private equity firm continues to grapple with a flurry of redemption requests. So people are knocking at the door. They're saying, "Hey, I want my money." And Blackstone is saying, "You can't have it." Now, Blackstone does have language in the contract that says they can do that, but that's still not confidence inspiring, right? You go into the bank and it says, the sticker on the door says FDIC insured, so up to $250,000. Yeah, but you never think you'll be in a position where you need to, actually avail yourself of that protection, right? So these people probably, these investors, and these investors are other investors, big time investors, they never thought that this would happen. We're talking Blackstone here. So we got $71 billion out there that these investors are trying to redeem, and they can't get it. The fund, the Blackstone Fund, Blackstone Real Estate Investment Trust, said it fulfilled redemption requests of $1.4 billion in February, which represents only 35% of the approximately $3.9 billion in total withdrawal request for the month. Okay, so they got a lot more people that want money than got money. All right, so that's not confidence inspiring. But the silver lining is that the total Blackstone Real Estate Investment Trust redemption requests in February were 26% lower than the approximately $5.3 billion reached in January, the fund said. Now I wonder what March will be now that this news is out, right? Should rates keep rising, it's likely that the March redemption flood will be higher again. Quote, "While gross redemptions for February are consistent with prior management commentary, the overarching data continues to align with our view around decelerating retail-oriented product organic growth broadly." So this is according to Credit Suisse, one of their analysts led by Bill Katz. Now, they're in trouble too, believe it or not. And we'll talk about that briefly in just a second. As we previously reported, Blackstone has been exercising its right to block investors' withdrawals since November of 2022 after requests hit a preset 5% net asset value of the fund, which is marketed to mostly high net worth individuals. So this one, you and I, the mom and pops, we didn't get hit on this one. It's the rich folk that are having difficulty here, but stuff rolls downhill. I'm not going to rejoice about them not being able to get their money because I don't want to see anybody in that position, okay? But apparently this is something that, again, was written into the contract. It hit that 5% preset level and triggered the roadblock on redemptions. Credit Suisse downgraded its rating of Blackstone stock to underperform in November, partly because of the rise in investor redemptions from this real estate investment trust. Blackstone shares were down 0.25% to $90.57 per share in afternoon trading on Wednesday, the 2nd, or the 1st rather, of March. The stock lost 43% of its value last year. Now, Credit Suisse, they've got some nerve downgrading anybody when you look at their position and what happened to them here recently. Every 2 weeks, we get some news that sends the Credit Suisse stock to an all-time low. At the beginning of February, the stock of the second largest Swiss bank plunged after it reported its losses would unexpectedly continue well into 2023, if not 2024, and that the bank run revealed at the end of 2022 was much worse than the bank had previously admitted. Now, bank run is when people run to the bank and say, I want my damn money. Give it to me now. And, you know, a bank can't operate without your deposits because that's what they use to lend out. And then they collect the interest off of that in order to, boost their profits. So what Credit Suisse did was they boosted their rate of interest that they're giving to clients so that they can try to entice folk to come in and put money into the bank, to have them, go back in the direction of solvency again. Citing sources, Reuters notes that the Swiss bank is offering a 6.5% annual rate on new 3-month deposits of $5 million or above. So they're swinging for the fences here. And they're saying, look, you got to keep that money in there for at least 3 months. And then they're saying that you can get a rate as high as 7% for 1-year deposits, far above matched maturity bills, and suggesting that to attract a client, the bank is forced to eat a loss. So I don't know, how much they're going to lose in that, because banks typically will offer you an interest rate on your money that is going to allow them some breathing room between what they're giving you and what they're charging to customers on loans. Okay, that's a spread. So if they're charging 7%, if they're giving you rather 7%, then they still got some room to maneuver if they're giving out credit cards at 16%. Okay, so don't cry for the bank. The hope, of course, is that after it attracts enough new clients, the bank will then be able to quietly lower the rates and make the new accounts profitable. However, as the various DeFi blowups of 2020, DeFi, decentralized finance, blowups of 2022 showed, it never quite works out that way. The banking sector has been responding to global rate hikes and higher rates, and Credit Suisse is fully focused on providing our clients with differential advice and competitive solutions. All right, so that's what we got going on with two of the biggest financial institutions out there, Blackstone and Credit Suisse, a major private equity firm involved in the real estate field, and a bank. Will we see reverberations of this to come in other real estate investment trusts? Is this just kind of like the canary in the coal mine about what's happening at Credit Suisse? Well, I can tell you what's been going on over there has been going on for a minute. So it's probably some other things that are happening. We did a report on it a while back. Listen, in these times, now somebody at Blackstone probably needs to watch this report we did a couple of days ago on how to double your money using the S&P 500. If you know someone at Blackstone, watch this report and then send them the link, okay? Now, this is something that's tried and true. Warren Buffett has been advocating it for years. Guys, watch the video, and I will talk to you soon.